Everyone on Wall Street is celebrating what they call a relief rally, but history shows that in a midterm election year, the middle of April is the most dangerous time to hold risk assets. I spent 15 years trading at a hedge fund and I have seen this historical anomaly destroy portfolios. I'm going to show you exactly why the relief rally is a lie. Let's look to history. This is JP Morgan's data going all the way back to 1946. It tracks the average path of the S&P 500 in midterm election years versus non-election years. Look closely at the white blue line. Midterm years do not go up in a straight line. They always peak in the spring, specifically they top out in April or early May. And then they bleed, they grind downward for 5 straight months until October. Now zoom in. This chart from Carson Research tracks only the month of April. Average returns flatten out exactly around day 18. So we are close to the precise inflection point where the midterm curse historically takes over. This happens because midterm years always bring massive political uncertainty in the fall, which creates a rising risk premium over the summer. The spring highs become the summer's nightmares. Past results are not indicative of future performance, but the pattern is devastatingly consistent. The mainstream financial press says this time is different. They claim the recent pullback flushed out the weak hands and reset the market. They're wrong and I will prove it to you. This is Goldman Sachs Equity Sentiment Indicator, so as of April 2026, it combines 9 measures of positioning across institutional and retail investors. The score is positive 0.7. Anything above 0 means investors are still net long. We are creeping dangerously close to the stretched level. The crowd did not de-risk, they bought the dip. Here is more proof from Bank of America. Their fund manager survey shows institutional cash levels just jumped to 4.3%. Yes, it is a jump, but it sits squarely in the middle zone. At a true market bottom, capitulation cash levels surge above 5.5%. Hedge funds are nervous, but nobody has panicked yet. And the market desk technical composite just entered the red zone at a positive 1.2. Months ago on this channel I warned you that silver was set to fall and equities were vulnerable, pointing directly to oil as the breakout trade to watch. All 3 of those scenarios played out exactly as mapped. This is what we do here. We spot the rotation before the crowd does. If you want the next play before it hits mainstream news, make sure you subscribe. Finally, this entire relief rally has been a mechanical mirage in the options market. Look at this dealer exposure data. As volatility compressed last week, dealers who were short puts bought them back. This created a Vanna-driven rally. This is not a fundamental or clear signal, it is a pure mechanics. Worse still, we are in a prevailing negative gamma regime. This means dealer hedging amplifies price moves in either direction. They were forced to chase the market higher, rounding out this trap. But be warned, if implied volatility re-expands due to renewed macro stress or an oil shock, those same dealer flows reverse in a negative gamma. That selling accelerates with terrifying intensity. This thesis suggests this is a textbook bear trap. We're at the exact seasonal peak, positioning is heavily long, option dealers are maxed out, and zero panic has set in. The strongest argument for a continued rally is simple. Megacap earnings remain solid and soft landing keeps the index afloat. I understand that view, but it assumes we trade in a vacuum. And it ignores the black swan that has appeared in the global plumbing over the last week. Look at Japan's 10-year government bond yield. It just hit 2.47%. That is a 27-year high. Why does this matter? Japan holds $1.2 trillion in US Treasury Bonds. As their domestic revenues spike, Japanese institutions must dump US bonds to repatriate their cash. This acts as a stealth tightening of global liquidity. It will continually force the US 10-year yield higher, choking off equities exactly when the midterm seasonality says they are most vulnerable. However, if the Federal Reserve intervenes and slashes rates and accelerates QE, this international yield pressure could evaporate and the bull market would resume. But given that we are still to see inflation coming from sustained high oil prices, I doubt that. Here is exactly what I am watching now. The midterm trap has been fully set. First, watch volatility. The mainstream is cheering because the VIX pulled back from its recent highs, but look closely at this chart. The VIX is structurally making higher lows since the start of the year. Baseline fear is not going away, it is accumulating. If volatility breaks higher from this trend line, the trap has sprung. Second, watch the US 10-year yield over the rest of April. If it walks above 4.3% and Japan's yields keep climbing, the summer drawdown of 2026 becomes inevitable. Do not get lulled to sleep by a reflexive relief rally. See you in the next one.